Welcome to our channel, guys. Today, we are going to talk about the key differences between cash and accrual accounting and explore the respective advantages and disadvantages. If you are new to accounting, by now you have probably heard these two terms, and most of the people get a bit confused in terms of how do we practice them in real life. So that's what this video is all about. Without further ado, let's go to the next slide. Well, with cash accounting, you have a clear picture of your cash flow in real time. It's simple and straightforward, making it ideal for small businesses with straightforward transactions. However, cash accounting may not accurately reflect your company's financial health since it does not account for revenue or expenses until cash changes hands. For example, if you look on the left-hand side, revenue is only recorded when cash is received. Expenses are recorded when cash is spent. Income is taxed when cash has been received. As opposed to cash-based accounting practices, in case of accrual, revenue is recorded when it is earned. Expenses are recorded when they are incurred. Income is taxed even if cash has not been received. It might sound a bit confusing. Let's go to the next slide and look at an example. In this example, we will look at a small food supply business and their quarterly transactions. And we will then apply both cash and accrual based accounting practices to see how much of a difference that make for their profit calculation per month. Let's say in January 2019, Mark received 150K worth of advance payment for meals to be delivered in Q1 2019. Mark paid 30,000 in January to buy rice, soft drink, oil and spices enough for the next 3 months to fulfill this order. Vegetables and other perishables were bought and used on a daily basis. The total cost for January 2019 were 15,000, which were paid in cash. John paid a chef 10,000 salary each month. Utility costs for January 2019 were 5,000, which were paid in February 2019, the following month. Mark rents a kitchen to run his food business. The quarterly rent is 15,000, payable at the end of each quarter. Now, if we take these inputs and apply both cash and accrual-based accounting practices, as you can see, in case of cash-based accounting system, the profit for Mark's January 2019 month is 95,000 as opposed to 5,000 in case of accrual-based practices. Let's explain a bit more. In case of cash accounting, revenue was recorded as 150K because that's when he got paid the money. Similarly, rice, soft drinks, oil and spices expenses were recorded as 30,000 even though that cost was for the entire quarter. And same logic applies for all the other items. Now, if we look at the accrual-based accounting practices, revenue was recorded as 50,000. And that's because 150K was paid for the entire quarter. And we need to proportion the amount of revenue generated each month. Similarly, the expenses, 30K for the entire quarter. Each month, the cost incurred was 10,000. And we applied the same logic for the other items. And we got a profit of 5,000 for the month of January. As you can see, it provides a more accurate picture of your company's financial position by matching revenue with the expenses incurred to generate the revenue, which gives a much better picture for the company's financial health. Accrual accounting can be complex and requires careful tracking of accounts receivable and payable. Let's take another example. Let's say Singapore Air's financial year ends in 30th of June. On 10th May 2019, a customer buys a return ticket from Singapore to Seattle for $8,000. The first leg of the ticket is for 20th of June 2019, and the return leg is for 10th August 2019. How should Singapore Air recognize revenue from this ticket? For cash accounting, it's simple. The revenue was earned on 10th of May because that's when the money was paid. Not so easy in case of accrual based accounting. Let's have a look. The core principle for revenue recognition in case of accrual based accounting system based on IFRS and AASB is to depict the transfer of goods or services at an amount that reflects the consideration expected to be entitled in exchange for those goods or services. So in case of, for example, on 10th May, when the passenger bought the ticket for 7,000, it was recorded as an unearned revenue for the company. On 20th of June, when the passenger took the first leg of his journey, a proportionate amount was recorded as revenue, let's say 3,500. When he completed his entire journey on the 10th of August, that's when the rest of the revenue was recorded. So 7,000 minus 3,500, another 3,500. In conclusion, both cash and accrual accounting have their pros and cons. Cash accounting offers simplicity and real-time cash flow visibility, while accrual accounting provides a more accurate representation of your company's financial health over time. Hopefully, now you know both about cash and accrual-based accounting practices. If you have any more questions, please leave that in the comment section and I'll try to respond back. Thanks for watching. If this was helpful, be sure to like, share, and subscribe for more financial tips and insights. Until next time, happy accounting.